Welcome back to the number one commercial real estate podcast in America, the Lone Star Capital podcast. We're manifesting here. Your host here, Craig McGrother, the host of the podcast, and of course, the director of business development at the premier and cutting edge firm here, Lone Star Capital, alongside, as always, the founder and principal of Lone Star Capital, Rob Beardsley. How are you today?
I'm good. I am exhausted. Been working super hard and had a bunch of interviews today for our new asset manager positions with an S. So that's really exciting. Some really exciting growth going on at the firm. And it's going to be a fun episode.
Yeah, absolutely. Well, we'll get into that. But before we dive into the meat and potatoes of this show, a quick little housekeeping reminder. Number one, we, of course, are raising for our latest acquisition in Dallas, Grand Riviera, an incredible 70s vintage asset. It is really feeling like an 80s deal. This is an incredible opportunity to invest in a really sweet deal with a ton of upside. This is a 506C opportunity, which means it's available only for accredited investors. To figure out if you're an accredited investor, you can Google that. But if you want to learn a little bit more about that process and what we're looking for and kind of develop the relationship with Lone Star Capital, of course, email me, Craig at lscre.com. Once more, CRAIG at lscre.com. There, sorry, I know, had to get it out there. If you're looking to raise equity for this opportunity or any of our opportunities or learn more about what a partnership would look like, please do that email. Send me an email. Love to explain what that dynamic looks like, the what's in it for you, which is most important. That's why we do anything. We're incentivized creatures here, naturally and inherently. So what's in it for you, you'll find out there. If you're looking to find about a return structure, why we provide some really interesting and competitive investment opportunities to the marketplace, please let me know. We'd love to answer for you. We're really excited about that deal. So if you're a capital allocator, if you're a 1031 exchange investor, the clock is running very tight here, but reach out to me to learn more about that opportunity there. The other housekeeping item, of course, is going to be our summit event, which I believe is the fourth edition of the summit event, September 15th and 16th in the one and only, the greatest city in the world, New York City. We're going to be at the Carnegie Club one night, and then the following night, following day and then night, so we'll go into today, we'll be at the One World Trade Center, having an unobstructed, perfect view, weather permitting, of the
Of everything.
Statue of Liberty. Of everything, but south side view of the whole entire city. You don't want to miss it. Everyone who's anyone will be there. But really, we hope that you'll be there too. And then we'll be following that up with Reserve Cut to Barclay Rex and Classic Tradition. So you do not want to miss that opportunity there. It's going to be a great event. So reach out to myself. There's an application process. Hopefully we can push you through. If you found out and on the application process saying that you are listening to the Lone Star Capital podcast and you just have to be there, perfect. We got you. I love it. So there is that for the housekeeping items there. Then real quick, what else do we have on the docket here? No, I think that's it for right now. Well, let's get into some really amazing news. I am really proud to hear you kind of say this, but I'm so happy to hear what you're about to say. So Rob, why don't you kind of break the news? Drum roll, please. Da-da-da-da-da.
Yeah, well, not to make this too dramatic, but I'll tell the whole story. So the whole story goes like this. Me and Kent have been, as we go off site, and I actually made a video about our off sites and doing the brainstorming that we do and the visioning, planning for the future, budgeting, etc. And we're looking at the growth of the firm, and we're looking at what we need to do in order to maintain and handle and continue to be successful as we grow. And one of the things that we had realized recently was the need for a COO. We need someone to step in and really drive operations top to bottom, from the on-site teams to the regional managers to the vice presidents to the asset management team to accounting. So that whole operation, as we all know, is the most important part of the business. It really drives everything. And I can belabor that point and I can explain that further, but I think everyone knows the importance of it, right? You just don't have a business without the proper property management and asset management, which obviously flows to investor relations and communications. So anyhow, with that realization came great responsibility because we realized that we needed to hire somebody who was very important, a COO type person, and finding this person would be a difficult task and a task that would take a lot of time. So me and Kent were brainstorming how we would go about this. We need to figure out an outline, a job description, and all that. So that was kind of our marching orders. Then the next morning, I woke up, went to the office, and I went into Kent's office and I said, "Hey, I think that we should hire me as the COO." And at first, it sounded like a crazy idea. Sometimes I have crazy ideas, but most of the time they work out. And Kent, obviously rightfully so, thought about it for a bit, and then we discussed it more. And more recently, about a week ago, we made the decision that this is the best move for the company, because who better to step into that operations role and impart the culture and the vision of Lone Star Capital top to bottom throughout the entirety of the firm, going all the way, from here in New York all the way to the leasing agents and the maintenance teams and construction crews and property managers across the portfolio. So I'm super excited about it for many reasons. For me personally, it's an amazing growth opportunity to really step up and dive in to a much bigger extent on the operations side. That's going to make me a better multifamily investment professional. So I'll be able to actually guide our acquisitions team more effectively and make better investment decisions based on my future expertise on the operations side. So I feel like, before I was, mostly just focusing on my side of the business, but now becoming a more well-rounded multifamily professional is going to serve, I think, the firm incredibly well. It's going to serve our investors incredibly well. And I know you jumped off for a second, so I've this whole time I've been burying the lead, and that lead is, by the time this podcast airs, I will have effectively moved to Houston indefinitely. I'll be living at our new acquisition, Preserve at Copperleaf.
My
so you
property.
can find me there. Your property, the property that you invested in, that I invested in, that everyone invested in.
Heaviest
So
co-invest in Lone Star history.
I'll be there. So if you want to come find me, I'll be over there. And for those that invested in that deal, know that I'll be literally there every single night, laying my head. So I think this is a very compelling story for investors, for the firm. I think this is going to be a really exciting growth phase that we go through, and obviously, hopefully, do everything I need to do, implement the processes that need to be implemented, revamp what I see, really bring, humbly speaking, the Rob Beardsley touch to operations, and hopefully everything I touch turns to gold. No promises, but I'm going to work really hard to make that happen, and then come back to New York, and hopefully we do eventually find that right COO person to put in that role, so that Kent and I can go back to doing what we do best and leading the firm to the next phase.
I think it's a really brilliant idea. And as an investor and as an employee, it gets me very excited to hear that you're taking that into your own hands and to do that as opposed to deferring it for someone else, because ultimately no one's going to care more than, probably you, Kent, myself, Dasha, and Co. and team, Brad, of course, and whatnot. So, and not to exclude anyone else from the firm, but that's truly a great idea. And the fact that you're willing to do that, get your hands dirty, just speaks to your level of diligence that you are wanting to really conduct and add on here to the firm, which is very exciting. With that said, I definitely think if you kind of just Google what's going on, around the business right now, the game is on hard mode. What do I mean by that? Well, collections are tough right now. The economy is not going to get better. Job losses are going to start happening probably more frequently, I would say. So, everything's going to get more challenging. So this is not because we're in a problem place. I would say this is because we're in a place of wanting to make sure that as the economy does and will change inevitably, nothing stays stagnant, but as things are just more challenging coming up for the foreseeable future, basically what you're just looking to do, if I'm not mistaken, just paraphrasing it here and kind of seeing around the corner is that you just want to make sure every little piece is in place to ensure investor capital is safe. Not that it's not safe right now, but to really bolster up our operations top to bottom, from the headquarters in New York all the way down to the leasing officers and maintenance people and the payroll staff on our properties throughout Houston, Dallas, and San Antonio. So we're just really looking to put that white gloves treatment on every single property. So if you're an investor or capital allocator listening to this should get you incredibly excited. If you're working with Lone Star already, and if you haven't worked with Lone Star already, this should just nudge you over the edge to give us a little extra attention and a little extra feel, maybe credibility as to boots on the ground operations, specifically in the marketplace. But really just putting on that extra level of care to the market, because, as I said, things are not going to get easier coming up.
I think you said it very well by saying that the game is on hard mode now. It's been a while since everyone was getting the benefit of rents going up every single month, and every year, a couple years in a row of 10-15% rent growth. You could sit back and kind of passively manage your properties and everything would go really well. We're seeing there are more challenges today. There's more challenges in the economy. Rent growth is slower. So we have to work extra hard to maintain status quo. And obviously status quo is not what we're shooting for, right? We're not shooting for average. We want to be great. So with that, it's going to require that extra care and attention and to really build things out. The other element, aside from kind of the market that we find ourselves in today, irrespective of that, obviously what gets you here won't get you there, right? And the success that we've had up to this point and the team that we've built and the systems that we've built have worked for a smaller, I'll say, 10, 20 properties. But where we want to go is 50 to 100 properties, which in my opinion requires a completely different set of expectations, systems, processes. So we need to build the company today with that in mind, right? We're not trying to just build the company to be able to handle today's operations. We need to build it with the future in mind.
Without a doubt. And I think it's really well said. What won't get you here, what got us here won't get us there. So as we kind of build out, putting those right systems in place, not that we don't have bad ones, but just really putting in the next generation of systems in place, the systems that take us from, a $500 million to $1 billion. Okay, getting to the first, half a billion dollars. Okay, great. That's where we are. Now we're at that $500 million plus mark. Now it's to $1 billion. And then from there, well, what's going to take us from 1 to 2, 2 to 3, 3 to 10, right? So the foundation that we're laying right now is going to propel us for the future. And it gets me very excited to hear your hands-on approach. And I think this is a great opportunity for everyone else in the firm really just to step up as you kind of take on that role, as you're stepping up, as you're taking more on your plate, for everyone else to kind of galvanize, come together, really roll up our sleeves here and really just stand on what we're doing and take more ownership in our day-to-day, take more autonomy, be willing to learn, willing to help. One thing that I'm really looking to do as well is, take you out of the day-to-day stuff on capital raising as much as possible and kind of equity relationships, which you've been grooving me for some time. But it's moments like this where you really get to see the fruits of your labor and the investment that you made over the last year and a half, 2 years to pay off with myself in this role and position, as well as Brad. So I think that's going to start to flourish very nicely, and I think you're going to hear a lot less emails there, and you're going to look up and be like, wait, what's going on with the deals? And you're going to call me, and everything's going to be sorted, taken care of, and it'll be a seamless process. So that's the ultimate goal, is to get you out of that spot there, to reinvest back in the company. And I think that's a very redundant theme. I think we'll look back at the year of 2024 for a couple of things. But I think the two things that I'm thinking about from themes already this year is, playing offense, which we're obviously playing offense right now, and then coupled with offense, the reinvesting back into the firm. And that's with human capital, with processes, with really kind of not reinventing the process per se, but really kind of rethinking about how we're looking at the entire makeup of the company, what we want to do, things of that nature.
Yeah, I agree. I like the ancillary benefit that you mentioned, which is for me to take on more responsibility, it requires everyone around me to level up as well, right? So we all do it together as a team. And just as a simple example to paint that picture, if you're working on a project or something And I know Dosh is working on a project today, and she was coming in here and asking me questions. And if I'm accessible, if I'm around, and if I don't create those boundaries, then yeah, Dasha will come in here and she'll ask me questions, and then we'll do it together. But if I say, you know what, I'm busy with other things right now, I entrust you to do this, she's going to go off and she's going to do it alone to the best of her ability. And obviously, there's the chance for failure there, but I think the willingness to fail and willingness to fail is also where the potential for growth is. And so if you just stay in your box, you stay in your comfort zone, then by definition, you're not going to grow. So I think that is another ancillary benefit of the opportunity.
Yeah, it just goes back to this. If you are comfortable in your job, then guess what? That means you're probably stagnant. That means you're probably not pushing and you're probably not growing. So being in a situation where you're pushing, where you want to grow, you want to take on more, and you're going to fail forward, I think is super crucial. So having that thought there, if you know you fail forward, learn, take on more, and add more to your plate. And that's kind of what I want to do on my end to kind of make this process more autonomous and really make sure this is streamlined and put on a platter for you and Kent to, of course, make the executive decisions with what direction we go. And for my specific day-to-day responsibilities, which is, you know, really the outreach and the capital raising perspective.
And leave a comment below if you think that I will meet my wife in Texas.
Yeah, well, that's actually, we're, you know, as Hunter Thompson would say, it's really some of the unseen benefits in these circumstances that truly, truly become very special and important. And I actually think, right when he told me this, is like, dude, this is God calling. And you picked up the phone saying, yes, I'm going to go to Houston. Why am I going to go to Houston? Yes, I'm going to make a ton of money. I'm going to, you know, bolster up the firm. I'm going to really take on all this extra incredible responsibility, but I'm also going to find my future wife. So how lucky are we? You're really killing two birds with one stone. That's the Lone Star efficiency. We're not leaving any meat on the bone here.
All sorts of unseen benefits that we didn't put into the underwriting.
Absolutely, absolutely. Kind of like how Grand Riviera is at a T on the intersection, which has tons of car traffic.
I do like that. That's a nice neighborhood over there.
Yeah, absolutely. So that's kind of the benefits there pertaining to you going there, and I'm just really thrilled for that to happen. As I said, operations is certainly not easy, and just kind of we touched on this last week, but there's just already kind of a good amount of foreclosures happening, capital calls kind of in the marketplace right now, and it's certainly not a fun time. And it's kind of actually funny. I haven't spoke to you with this yet, but was speaking with my dad yesterday, and he's got one of his clients who is looking to move his banking over to Morgan Stanley away from where he was because he was actually at none other than First Republic, which isn't really in the best place, obviously, from before. So he was moving over his personal banking with an investment banker over at Morgan Stanley, kind of learning about the rates and kind of moving over more dollars there from a lending perspective, right? So he actually, his niche is in self-storage. And he was just saying, listen, like right now is the best time to buy. He's like, what he does is actually very under-levered, typically speaking. He puts down like 60% of equity in deals when he typically acquires them, believe it or not. So he's in all sorts of real estate, but he's like, listen, right now is just the best time to buy. He's like, I don't know when the bottom's going to happen. I don't know what it's going to look like, but I do know if you can buy a deal right now, it makes sense. And I'm like, okay, well, this guy's been in the business for a while. This guy takes less leverage than what we would typically do, but to hear him say that is super great.
Yeah, and I agree. It's every day, right? You're having conversations about, okay, where's the market going? Where are we? Where are we headed? And obviously nobody knows when that bottom is, but I feel like it's not like, oh, close your eyes and buy any deal in the market today and you'll make money. Maybe that will turn out to be the case, but I'm not calling for that. But I do think right now there are some incredible buys, and we've been fortunate to already be able to pick up some deals that I think we'll look back at and be very, very happy about. So, yeah, I agree with that sentiment.
Yeah. And then one thing I want to talk about as well, which is, making good buys and kind of just being adaptable in the marketplace and not being too stubborn with anything, right? Deal structures, what you're doing in your day to day, just really having an open mind and wanting to pivot and adapt and be wise. And something that makes me think about that right away is what we've done with our deal Grand Riviera, which of course I give a shout out to, which by the way, when we got the deal in contract, it was 90% occupied, but now the deal is already up to 96% occupied, which is obviously really lovely because we bought it on the basis of it being 90% occupied. But nevertheless, what's very exciting is, the amount of I guess the new debt structure you have on it. But also, I just want to talk about this theme, and Rob would love for you to unpack this, which is, when you get new information and better information, or you learn more about something, sometimes we're in the middle of the process, we like it, and then we'll like it more. But having the wherewithal and kind of not being stubborn to change your thought process and opinion and structure on anything. And specifically, what I want to talk about is Grand Riviera. So I think we've kind of changed around the structure of this a couple of times, but I just want to hear your perspective as to, why we've done it, why it's more beneficial, and how we're always putting investors first.
Yeah, well, it's actually an interesting topic we'll talk specifically about Grand Riviera, but then we can also speak more generally about this topic, because I do find this quite interesting. And this topic generally that I'm referring to is this concept about keeping things stable and simple versus being adaptable and changing things up, like you mentioned. And if you are smart and if you are adaptable and you are always pushing and seeking for the best opportunity or to tweak things so that way you can create the most value for investors, that's awesome, right? And if you do it successfully, then you will in fact create more value for investors. The problem with it, though, is that investors don't like change, generally speaking. And also, it's not, obviously, you can't paint investors with one single brush. There's a spectrum of investors, and unfortunately, what I will say as a generalization is the more sophisticated investors, right? As you go up the sophistication curve, their willingness to tolerate change goes up as well. So what that means is that the less sophisticated an investor is, the less comfortable and willing they are to tolerate change. And for example, let's use a real example like Grand Riviera. I mean, Grand Riviera, it's been, I'd say we're pretty relaxed, but it's been a roller coaster because we put the deal under contract or under LOI, and then as we were negotiating the contract and right before we were ready to sign the contract, rates ran up quite a bit. I want to say nearing 50 basis points.
Yep.
And that for anyone, not just us, for anyone, that would really blow up your numbers if you were financing based on treasuries, which would mean you would be financing on a fixed rate, which was our original intention with the deal, was just to do agency financing with a fixed rate. So then we decided to pivot to a 70% loan to cost bridge loan on a floating rate basis, because floating rates they're not volatile like that over weeks like treasuries are. And we could mitigate our interest rate exposure through a rate cap. So we made the decision to do a bridge loan for those reasons. We thought that was the prudent thing to do. It made sense. Also, Grand Riviera has a very substantial CapEx budget. So it's actually more capital efficient to use a bridge loan where you can draw down CapEx funds from the bridge lender, and you're only paying interest on drawn down funds. So it's like if you're not using the money, you're not paying interest on it, and then as you do the work, you start drawing it down. Whereas if you raise CapEx out of equity, you're going to have that equity sitting in a bank account, basically. Yes, it can be in a brokerage account earning 5%, which is not bad, but equity is expensive, right? So that equity is going to have to sit there, and it's going to burn your pref, and it's going to dilute your returns. Not saying it's a bad thing. I'm all about financing CapEx out of equity. That's just the truth of it. So that was the pivot, number one. And then we did pivot number two, most recently, which was super exciting. And we pivoted back to a fixed rate agency loan, but coupled with a lower leverage agency loan, coupled with a $4 million preferred equity slug to get back to a $24 million proceed amount equal to the 70% loan to cost bridge loan. So keeping leverage the same, but going back to a fixed rate structure. And with the preferred equity, you have a current and accrual payment concept with preferred equity. And that's very common. Most preferred equity structures include a current component, which is basically a monthly interest payment that you pay on the preferred equity, and then an accrual component, which is you gross up the preferred payment upon a capital event. So we were able to substantially lower our cost of capital on a current basis by switching to this more complex structure. And again, talking about complexity, talking about change, even if they're for the better, it is difficult when it comes to investors to go back to them and say, oh, you know what, we actually changed the deal structure and we made it more complicated. A lot of investors would just go, okay, no thanks, I'm going to pass. It doesn't make sense. So I think we're really lucky because although we are in the syndication space more or less, yes, we have some institutional partners and some very sophisticated partners. We still are kind of generally in that more syndication space, which obviously, unfortunately to say, is generally less sophisticated. But with that in mind, I think we kind of are on the more sophisticated end, just given the way that we are and who we attract and the investors that we're lucky to have. So our investors, you can chime in on this because you're talking to them every single day. Our investors have certainly stuck by us. They've been excited by the concept. However, I haven't quite seen. Have we had anyone who originally passed on the deal and then because of the change got excited enough to the point where they decided to jump in?
Well, I think it's too tough to say too early if they were out then in due to the switch of everything, due to the fact that maybe they didn't explicitly say, "Oh no," because I think a lot of times in the culture we're in right now, no one, if it's a no, they're just not going to get back to you. If it's a yes, they're going to obviously funnel into your systems, right? I think we all can appreciate that. A little ghosting here and there. However, I will say that commitments have been really special on our tranche that we're raising. I think honestly, from the deals that we're going to do so far this year, this will be a third deal that we're raising, which, by the way, how incredibly market diverse are we? First deal, San Antonio. Second deal, Houston. Third deal, Dallas. One in each. You're welcome, people. But nevertheless, I think people are really excited about seeing a Dallas deal regardless. But when I have spoken to people on the phone, when I did update our capital partners in this opportunity, when I did kind of break down the change and the pivot, they were ecstatic. They liked the deal, and then kind of when you break down the economics and also the longer tarmac that we put on this deal with a 5-year fixed rate debt term juxtaposed to a 3-year bridge deal, and also when you factor the fact that the rate's cheaper, the debt is cheaper, or the rate is lower, the debt is cheaper, and then also we've got cut the risk down in half due to 2 extra years of fixed rate debt. I mean, you cannot beat that. You really can't. So everyone was thrilled, and I think the interest is very infectious. One thing I will say that has been a little bit challenging per se is some of the capital partners who initially maybe said no on the front end due to the debt structure, kind of just moving on there for the next deal to raise for, which is very understandable. We're finding the partners; it's not a problem. We still maybe, as we speak right now, a little bit of space. We're gonna get some 1031 exchange money coming in, so we're in a very good spot. No panic alarm or anything like that being hit by any means, but it is interesting to see that some people, once they kind of heard that and they had that in their head when they went from A to B to C, are just a little bit are they're harder. They're having a harder time, I think, wrapping their arms around the switches as much as our capital or sorry, our investors. So it is kind of an interesting thought there that some people are more malleable and easier to get on board than others, and I understand. Everyone's going through the process, and make no mistake, raising equity is very challenging right now, and this is just another kind of caveat to the capital call, operations getting harder. I think you were on the conversation on a phone call as well from one of our capital partners, is one of our really, really lovely people, will go nameless, who is basically just, really nervous about everything kind of going on in the marketplace and, is just struggling because some deals that you raised for, not that it's fault, it's just the math is just really struggling right now with the debt structure, with how hot the market was before. And, when rates effectively triple in a short period of time, you can't outrun that. It's just really a tough situation. Unless you put on like 10 or 7-year fixed rate debt, which very few people did, you're really in just a predicament currently. If you want to maybe expand on that a little bit more as well, that would be really cool too, just on your experience there.
Well, one thing I would like to go back on because you mentioned about things are really hot on our tranche. And I just want to
Yeah,
have you
cool.
explain that because not everybody knows
Yeah.
the inner workings of our cap table and our different relationships. So that's number one. And number two, yes, I totally agree with you. It's been really refreshing to see the interest coming from some of our existing investors as well as new investors. I was scanning through the investors that are signed up for this latest deal of ours, Grand Riviera, and some of the names there that was really interested in seeing. They were like people that are in the real estate professionals. They're in the business. They've been following us for years, and then this is the first time that they're investing with us. What
That
does that
says
tell you?
something. That
Yeah,
says a
what does that
lot.
tell you, right? It's
Yeah, that
interesting.
that's a story within the story there, and I think that's really interesting. So let's go break down some of this jargon. So for our raise, how it works, let's say, so this deal is a $13,500,000 raise. Okay, so the way it works is there's a couple ways you can get it done. You of course can raise all the money internally. We don't need any outside equity. You could raise the entire deal cash, which means you're putting 30 million plus down. You're probably not going to do that. You want leverage returns. Leverage returns are the way to make money in real estate, obviously. So let's say it's a $13,500,000 raise. There's two ways, or I guess three ways. You could raise the money all yourself internally. You could have a capital partner come in and raise the entire check, and then you manage the property. You could do a hybrid, I guess there's an additional way, or you get a joint venture equity partner who might do an 80 or 70% of the equity check, and then we raise the other amount internally and from our pockets for a co-invest. And then the latter is kind of a blend where you do maybe some institutional or some of our boutique capital raisers, fund managers, capital allocators that come in through a fund-to-fund structure where they create an SPV, special purpose vehicle, into the deal of ours, and then they kind of stack that in there, and then we'll raise from our investors called retail investors into our capital stack there. So we, I think right now, already have about 2.5 of commitments, and we've got about $3 million we're personally planning to raise. And we may flex that up a bit if there is space and that opportunity there, but that's very exciting. And to your point on names that we haven't seen before, we're getting all sorts of commitments. It's really cool to see. And as you know, and I've kind of made it out, and as I had a very, very daunting week, so I'm a little bit brain scrambled. This might be a little bit shorter of an episode than usual because Rob and I have really been on our grind and on our purpose this week. But I've called about 600 people this week, capital allocators, as well as retail, or our in-house investors, people that kind of come into our systems, into our CRM or database. So I've called about 600 people this week, and it's been very nice feedback. And you know what the other interesting thing is as well is, although some people are not going to invest in this deal as well, they're very excited about being on our list, and they want to see our deal flow. They want to see our distributions and are just very curious as to what we're doing right now, which gets me very excited because curiosity is the spark to an investment. So you can't, it's very hard to get investors into this space if someone's not curious, doesn't want to see what's going on. So it's really nice to kind of honey trap everyone in on an opportunity like this and then hopefully convert them in time. But there's been a ton of people as well that are new that I haven't even spoken with that just commit. So I'd love to see that. And also, there's been several people who've invested in this deal who found us from where? Here, this podcast. So tip of the cap to us. And that's, legitimate. I think I said that yesterday on our consulting call with Hunter Thompson, our friend, who, we were talking about, how do we get more numbers on shows like this, which please like, comment, share. If you can, subscribe. That would really help us a lot there too. But, we're getting a lot of interest and a lot of, I would say, trust developed just from the show alone. And that's been really special to see. It's very rewarding.
It is very rewarding. Yeah, and everyone has a different journey. Everyone has a different investor journey. Some people, like you said, they may not really be interested in a very hands-on approach. They don't need to talk to you on the phone. They don't need to take years of due diligence or to call references. They just like what they see and they feel comfortable on their journey, and then they subscribe and invest for the first time with us, and then hopefully we treat them well, and then they become a repeat investor for forever, right? So, but other people have a different journey where they might kind of get to know us, they might see some content, then buy one of my books, maybe have a phone call, then an in-person meeting, and you never know where someone's journey is going to be, and that's kind of the beautiful thing about it, where you might have met someone, or I might have met someone years ago, and then now they're just investing for the first time, and it's all good. That's kind of the beautiful thing about that, right? Is what we're building is we're here today, not gone tomorrow, right? We're here today, here forever. And that's great. We don't need to rush anything. And, right. It's just I just, super happy about the business and about how everything's coming together. So
perhaps I shouldn't say this, but I'm almost very laissez-faire. I'm very passive when I speak to an investor. I'm like, what are you looking for? What are your goals? Of course, like anyone sales, anyone got life, make it about the other person. Okay, so ask them all the questions, make them feel good, see what their goals are, see if there's a mutual fit. And I always send them a deal, and like, can you send me a deal I'm working? I'm like, yeah, sure, here you go. And I'll say this again, and again. Hey, if you invest with us in 5 days, great. If you invest with us in 5 months, great. If you invest with us within 5 years, great. We're here indefinitely, so it's whenever you feel comfortable with us. We want you to love the deal as much as we love the deal. And I've said that a zillion times, so I sound like a broken record internally here. But it really is true, that powerful statement of, hey, this is about you and your journey, your experience, as you just alluded to. So we want to make this as positive an experience as possible. This is not a high pressure sales job. And it's so interesting too, because as I've been on the phone, as I said, literally the last 3 days I've been glued to it and calling. Okay. And it's been very interesting because everyone is so polite, and not one person had, any sort of attitude or any like, why are you calling me? Who are you? It's very, I almost would say, irregular to call as many people as I did, to not have one person who was, MFing you, or, wasn't happy or pleasant on the phone or respectful. So, and I'm the one that's pestering them with a phone call and an email and a text, and we're spamming them very nicely to make sure that this deal is funded, and make sure that everyone has got an opportunity to invest in it. But it's just a very special thing that we're building here, where we can actually do that. And a lot of people that I'd never met with, never spoke with, who were like, oh, I know you from blah, blah, blah. You guys are great. So just hearing that is awesome. And, if we can raise dollars in this market, if we can buy in this market with the rates right now, with prices depressed and the market kind of in a tough place, we're in a good spot.
Couldn't agree more.
Yeah. So just want to talk about the pivoting of the deal. Some more actually really good updates. So just as I mentioned, we're going into the deal now with 5-year fixed rate debt. And I was actually really surprised to hear about this too. But we have a 3-year yield maintenance. So we're doing a 3-year bridge deal before. Okay, obviously at 3-year mark, you get the 1+1, typically speaking. Correct me if I'm wrong. So we have the 3+1+1. But this deal,
Can you explain to people what that is?
yeah, so a bridge debt term, to my knowledge, and I have a guru here who legitimately wrote a book on, debt and equity. So you'll, correct me real time here, live on the podcast. So I'd love being on the hot seat here. But when you do a bridge loan, you get a 3-year term, and then you get an extension of a year plus a year, typically speaking. So there's a lot of deals, let's just say, that were bought in 2021 that right now are having the maturity coming up where they need the 1-1 extension, okay? So those deals are likely deals that by and large may be struggling right now. But we were going to think about buying this deal because we think right now it's about as low as the market could get. So we did think that the 3-year debt structure was pretty beneficial and accretive to what we're looking to do with the forced appreciation play with what the market conditions are. With what we're doing right now is we're buying the deal at a 5-year debt term, fixed rate for that 5-year period, but then at the 3-year mark, the yield maintenance runs out. So we can sell that property early at that 3-year mark with no prepayment penalty. Now, one of the downsides to fixed rate debt and agency debt, and why some people do not like it, is because it is a very hefty prepayment exit penalty to sell your deal early, if that's where it's at. So there's a couple of ways you could do it. You could do a loan assumption to kind of get around that. There's a couple of tips and tricks you can do to try to mitigate that cost there. But by and large, it's a very expensive payment. So that is kind of the shift there. So the fact that we have this deal where we still maintain the same flexibility essentially to exit as a bridge deal will do just goes to show how special this debt structure really is.
And just to kind of clarify how it's possible, right? Because you can't just get something without giving something in return, right? And typically speaking, like you said, you have yield maintenance or defeasance on agency fixed rate loans, right? Because you get the benefit of a fixed rate, but then you have to have the downside of a onerous prepayment penalty. And the way that we were able to structure around that is there's various buy downs on the prepayment penalty that you can structure into an agency loan. So the way we're structuring it is instead of on a 5-year term, instead of having a 4.5-year yield maintenance, you have, see Kent peeking in.
I did, as a matter of fact.
I'm needed.
Kent's on the podcast for the second time. I'm happy he made another appearance.
There we go. So, yeah, on a 5-year term, you typically would see a 4.5-year defeasance or yield maintenance, and then we're able to pay a little bit extra on the interest rate to buy down that prepayment penalty to 3 years, which then essentially gives us a lot of flexibility so that if we sell the property after 3 years of ownership, the prepayment schedule has run its course and you can actually exit at par. And then if we were, let's say, to sell or refi in 2 years, we would have a year of yield maintenance that would be responsible for, which would be manageable in that scenario, right? Assuming, because we would only sell in such a short period of time if we were very confident about it being a great outcome.
Amazing. Yeah, well, we're just thrilled about this deal. Just to play a little, inside baseball here, behind the curtain, my personal life, which I know no one asked for, but I'll tell you anyways. Just like I did in Cortland, I'm also investing additional cash into this deal outside of the acquisition bonus that I'm getting for this opportunity, which just really speaks to my confidence and conviction of this opportunity. I have plenty of expenses and bills and places to put that money. Maybe I'd want to buy myself another watch. Maybe I'd like to extend my Europe trip a week longer. But instead, I'm throwing it into this deal because that's how confident I am in this opportunity. So if it's good enough for me, someone who's in the business and seeing it day in and day out and that much more confident, that is, I think a very nice canary in the coal mine, if you will. And on top of that as well, I was obviously planning on putting my acquisition bonus into this deal under the old structure, but once the structure changed to this fixed rate debt scenario, I was that much more all in on this opportunity and called with that much more conviction with all the people that I was connecting with as well. So that really just speaks to how great this opportunity is, how much we're really excited for it, and as much of a no-brainer it really is. I mean, it's not easy to buy a deal in Dallas right now, or really anywhere. And I think we're really seeing that, kind of play out in real time, that it's just not easy to make things make sense right now. But when things are hardest where it makes sense to buy, it's probably the best time to buy. So I think we're really in this window right now, 2024, 2025, and probably 2026, that are going to be historically great years to invest. So this is the time to get in, to get your ducks in a row, and to really make those investments.
I think 26 or back half of 26. It's not going to be too late, but it's not going to be the same as right now in 25.
No, it will certainly not be as frothy.
The back
26 is
half
like,
of 25 could even not frothy, the opposite of frothy. Right now it's
yeah,
dead.
yeah. No, I was saying it probably will not be as frothy as today. And just generally speaking, I also think that, well, yeah, so I agree with that. And then another kind of thought as well is, the really impressive lender spread that we got in this deal. Can you kind of dive into how we got such an attractive debt structure? Because if I'm recalling correctly from our conversation when you told me this, I was like, well, what's the catch? Like, what's going on here? There's a give and take, as you alluded to earlier. Why is this so good? And I think you kind of mentioned something really interesting just about the marketplace right now with the stifled transaction activity. If you want to kind of get into the lender spread, the whole nine, and kind of the nuts and bolts here, just to really kind of cement these items together.
Yeah, I mean, agency lender spreads, and I would probably say lender spreads in general, are probably not as volatile as index rates, but they're still volatile, and they are subject to change. Specifically when it comes to the agencies, Fannie Mae and Freddie Mac, they will adjust their spreads depending on what they're trying to accomplish. And also, they're trying to hit their lending caps, which I believe this year they each have a lending cap of $72 billion. So I might be wrong about that, but it's somewhere up there. And they want to fill those caps because if they don't hit the cap, then they might get a downsized cap for the next year. So they always try to meet their caps, but they try to regulate how much lending business they're doing with their spreads, right? And obviously, if they start charging higher spreads, their debt is going to be less attractive and people are going to go elsewhere. If they want to put more money out, they'll lower spreads and they'll do that. Then they'll be able to do more volume. Similarly, they will have spread discounts depending on the type of the market and the product. And so spreads are dynamic based on that as well. And something that has become a bigger initiative for the agencies, as it has always been, is workforce housing and affordable housing. So the agencies are providing spread discounts on deals that qualify for their affordability standards. So a deal like Grand Riviera, because it is in a workforce housing pocket, it's an older property with lower rents, we get to take advantage of mission-driven spreads, which are superior. So that's always what you want to capitalize on as well.
That's really great. So it's nice that we're buying that there. We're not price gouging these tenants. We're creating a better environment for the families that are there. We're going to make our investors a lot of money, and we're going to put everything together nicely. Well, as I said, we're going to keep this episode short, brief, and brilliant. We've had a very busy week here. Rob, enjoy the transition year coming up. I look forward to seeing you in H-Town in a couple of weeks here. We'll be doing some content there, of course. Very thrilled. Any last thoughts before we go away here?
No, I'm all set.
Cool. Well, some final call to actions for y'all here. One, we got our deal here, Grand Riviera, which we're raising equity for. If you'd like to learn more about this opportunity or anything else pertaining to this deal, anything under the sun, you let me know. I'm available. You know the email. Once more, it's craig@lserie.com. If you are looking to learn more about our summit event, which will be held in New York City, September 15th and 16th, please let me know. We would love to help you. There's an application process, but if you put in there, listen to the Lone Star Capital podcast, you maybe just will get a way in a little bit easier. And then finally, we are going to be in Houston early June. Maybe we can connect if you're an investor or capital allocator looking to learn more about us. And to that, we say thank you so much for tuning in. Thank you so much for hearing us today, and we'll catch you next week. Peace.